Yeah, Min, thanks for joining us on our third quarter review. One of the reasons we looked in having you join us, certainly we know each other for quite a while, but you've done an excellent job managing the Meridian Equity Income Fund. You're, at least from a few days ago, the second ranked equity income fund this year out of 142. We'd like to get your take on the quarter and what's helped your fund excel so well this year.
Great, and thank you again for the opportunity. I just want to apologize for the inconvenience I caused everybody. But with that, I'll maybe jump right in. Y'all highlighted, I think, a lot of the key economic underpinnings that have really, I think, taken hold of the market attention in the last 3 months. And in the slides that you presented here on page 33, there are, two that I think it's worth talking about. One is the disruption that oil has caused into the market. As you talked about, essentially in the last year or so, there's been a lot of dislocation in the market, particularly from a market share perspective, where essentially Saudi, being the only member with spare capacity, has really tried to reassert its position to get more control over volume and driving price. Here's the issue. Basically, there are three producers in the world that produce about 10 million barrels of oil per day. We have Saudi Arabia at 10.5 million. We believe they're at full capacity. It's hard to say. United States recently joined the 10 million club with about 4 million barrels a day coming from fracking and the shale revolution. And Russia produces over 10 million barrels a day. Of those three, can you hear me?
Yeah, I can hear you fine.
You're doing well. The problem is everybody's unmuted here. So you know what? Are you on that participation line, or are you on the chairperson line?
I'm on the chairperson line.
You know what? Let me go ahead. I'm going to go ahead and mute the other lines so that way people can talk and that kind of stuff. So I'm going to give this a try. Hold on, man. Sorry.
Presentation mode is now enabled.
You're set.
All right. So essentially, what we have here is I think it's a very big political calculus on the part of Saudi Arabia to do one of two things. I think they endeavor to either A, test the resiliency of the American oil producer and the capital markets, particularly the high yield debt that supported a lot of the drilling activity over the last 4 years, and or change the production calculus of Saudi Arabia, possibly get them to join OPEC. In terms of how this has impacted the markets, you can imagine there's a lot of disruption when you built a capital markets function around $100 oil that quickly went to $50. And so essentially, what I see here, though, is an opportunity for active managers to think about on a value perspective, where they want to pick their spot. In terms of just doing basic math, what I focus on is the fact that if you take Saudi's total government expenditures, in 2007, the total government expenditures for Saudi Arabia were 131 billion. 2014, it was 320 billion. This year could be 330 billion. So what you've seen is almost a tripling of spending by the kingdom in just less than 1 decade. If you take that $330 billion government expenditure that they're going to do this year and take that against about 10 million barrels a day of production, that's 3.6 billion barrels that they'll be producing. What you start to see is their true cost, government expenditures to a barrel of oil is $91 US. And so what we have is a large production region in Saudi that can produce oil very cheaply, but no one talks about the societal cost of another $90 on top of that. So from a budget impact, I project Saudi is going to probably draw about $130 billion in terms of their surplus. So they're going to run a $130 billion deficit. And so when you compare that to $730 billion in foreign reserves at the end of 2014, you can see it's going to fall to about $600 billion in 2015. But more importantly, if you start running the math, $50 Brent oil for the next 3-4 years, 2016, 17, 18, all of a sudden their deficits start to look like minus 120 or 130 billion in 2015 to 160 billion in 2016, 175 billion in 2017, 200 billion in 2018, and their FX reserves will go from 700 billion to 600 billion this year, 450, 275, and 100. So there's a clock on how long, from a political and market share perspective, Saudi can maintain the low oil price, hold up their production, and sustain and bear the brunt of this price dislocation. The Greek debt crisis, this is something that happened more of a, kind of Q2, end of Q2 type event. At this point, substitute your favorite emerging market jurisdiction. China seems to be a good one here. I changed it to hashtag China Meltdown. And as Jeff mentioned, essentially, we have a really large economic shift in the fact that China, for about a decade and a half, built a lot of factories and really relied on fixed investment, building factories, building industrial production capability, manufacturing power to try and grow the economy. And by a lot of measures, what we saw was over 50% of Chinese economic growth came from these heavy capital-intensive, heavy industry type investments. And over the past 5 years, their marginal productivity for this type of economic growth has diminished. And so they're in a very big transition to try and modernize their economy to make it more consumer-oriented, while doing this still in a very top-heavy command and control type fashion. Will they get there? Absolutely. Will they get there in a smooth fashion? I don't know how they're going to land this backflip. And so that is, again, the macroeconomic issue at the moment that is upsetting the market. Gold is an interesting one. In terms of the portfolio, I continue to hold gold. I've spent more time trying to analyze gold over the past 7 years than probably any other single investment. And I've basically come to accept that I know no more about how to predict the price of gold now than I did then. Given the economic conditions and backdrop, I would have thought gold would be much higher than where it is today. But I continue to own this. That is a top 10 position in the portfolio, in part because the less I can understand and explain it, the more I believe it will protect me in a crisis scenario. So that is up for discussion if you think I'm insane or if that might actually hold true. The next slide on page 34, just to give a backdrop in terms of how I think about long-term investing and why I think it's really critical for our clients to think about equity and you all to think about the role of equity just as an asset class in your portfolio. And I'm also going to put in a plug for active management here in a bit. And if you look at the blue line on slide 34, through any number of frameworks that you want to look at, this might be the most common one that people think about, the historic price to earnings ratio. You can see how it has bumped between 15 and 20 with occasional trips like this 29, 66, and 2000 to the, what they call, above 2 standard deviation type breakout. You also see some of the troughs that we've seen, 21, 81. But what I think is powerful is, again, if you look at this orange line, the idea that over a 150-year history, we've seen about a 9% CAGR in terms of the price appreciation of the S&P 500. I think, there are always questions, hey, what if I invested and I ended at 81? Or what if I invested and I ended at 2009? And I would like to maybe flip this to slide 35, and I don't have an additional slide here, but I'll talk through it. If you look at slide 35, what this says is, hey, if I were, and this, you kind of think about the buy and hold strategy, but if I were to have invested in the S&P 500 at 1927, so that first data point, 27 to 57, what that says is we calculate you would have earned a trailing return of 8% on average over that 30-year time period. As you can see that even with all the fluctuations in place, on average, this asset class, equity, and in my case, thinking just long-only equity, just a very broad, diversified equity index, about a 9 or 10% trailing return over that 30-year period. And you can also compare that to the return for cash. Again, these are rolling returns. Cash certainly returns far less than 3.5% today. But also compared to the 10-year Treasury. 10-year Treasury had an outstanding run over the last 30 years, in part because, as we all know, we've seen a generational secular decline in interest rates. And what's I guess the money slide to this, which I'll talk to, is that we also, following this, and this was a slide presentation, by the way, that I presented just a couple weeks ago in Beaver Creek, Colorado, for the Colorado Public Plan Coalition. And so you can imagine, and the meeting was on September 8th, so China meltdown, everything was pretty fresh on people's minds. It was about as depressing of a market investment conference I've ever been to. But the slide that I really wanted to focus on basically takes slide 35 and then asks a slightly different question, which is to say, taking this exact same return series, if I were to dollar cost average, so in the case of 2008, which would have been your worst time to end your 30-year or 40-year run as an equity investor, but in 2008, if you had started in 1978 and contributed $1,000 a year, so again, these are just flat nominal contributions, $30,000 a year in $1,000 increments over 30 years, even at the end of 1998, your $30,000 would have grown to something in excess of $160,000, so about a 5.25 multiplier to your cumulative principal over that time frame. Again, these aren't adjusted for real terms or anything else, but it's a simple nominal illustrative exercise. And compare that to if you had done the same thing in 10-year treasuries. In other words, at the worst moment in equities versus the best moment in 10-year government bonds for U.S., and you still would have made more money, 5.25x versus 4.75x. And what that demonstrates, again, going to page 35, in my belief, is the power of the equity risk premium over a generation of investors. And, in here we can say it's 3 to 4 points. ERP, as you know, is something that's sort of observed. If you think about electrons, we don't quite know where they are, but we know that they exist. And so it's moments like this. It's the freak out over China meltdown. It's concern over Aussie 2015 and the Greek debt crisis. It's oil going from 100 to 50, and my bet back to 80 in a contracted time frame because of different economic backdrops. We are going through a myriad of regime shifts right now, which I think are testing the cumulative experience of the buy-side industry. I started, by the way, I can keep monologuing forever, so if anyone has a question, please jump in. But when I started in this industry, I started in 1998. I came out of college, I went to Janus Fund, and 10-year money was about 4.5%. In fact, in 2007, I did a 3-year CD at 4%. Basically, that's outside of 30-year bond money right now. And so what we have here is a generation of portfolio managers who have seen nothing but a secular decline in interest rates. We've seen nothing but a generation of growth in emerging markets, largely led by the rapid industrialization and catch-up mode of truly impoverished parts of the world. They're at a moment of decision right now. Politically, are they going to make it or not? We've seen, I believe we're starting to see breaking of regimes such as the petrodollar. We know that countries are trying to form other denominations and trading and currency exchange swaps outside of the U.S. dollar. So that's going to be on people's mind. And also in terms of U.S. indebtedness, we've gone from single-digit trillions to 17 trillion in debt, and a lot of this is held by EM. In the month of August, China inadvertently ended up spending $100 billion to defend the renminbi because they weren't successful in carefully managing a slight devaluation. A lot of things are in flux right now, and these are, I think, market structure, economic regime. These are, I think, larger trends that are far larger than anything that we can control. And the other thing to think about is to what extent are all of these issues around overcapacity, indebtedness, where you think we can go, to what extent is this a demographic cycle that the developed world is struggling with? Again, very big question. In terms of the Equity Income Fund and our strategy, I believe that this is an enormous opportunity for active managers who can try to manage the risk. So I didn't really talk about return opportunities from EM. I view these as sources of risk. But I see enormous opportunity right now to think about companies that are actively coming up with strategies to operate in this new environment. And the one that I'm thinking about is the impact of digitization. This is a central theme in my investment portfolio. And when I talk about digitization, I think the easiest cut of it, the first one I think people tend to think about is social media. And it's in our face. Facebook is a top 20 market cap right now in the S&P 500. And basically, it's more than just how Facebook has really become a pervasive part of our media consumption. Essentially, my wife and I in the evenings, we are on the sofa, we're looking at our iPad and iPhone. TV is a backdrop. If you think of Amazon, it's Facebook, Google, LinkedIn, Microsoft, Twitter, all of these social networks which are able to connect billions of people seamlessly, effortlessly, instantly, and all searchable and archivable. I think digitization is going to completely transform the way we think about big data and understanding consumer behavior. There are going to be companies that are going to be able to capture this trend better than others. Omnichannel is going to be very big. The consumer expectations of having a remote competing advice, and I think the iPhone 6 is going to has brought in sort of era 2 of the smartphone. There are companies that are not going to make it this transition. Walmart has been one of the outstanding, iconic American success stories of the past generation. At this point, they talk the game. They understand that they got to go omnichannel. They're rapidly trying to put in the platforms to engage consumers the way we expect to be engaged now in the year 2015. The question for Walmart, can they change their business model of a footprint of 800 million square feet distributed in the U.S.? Can that business model evolve faster than changing consumer preferences? Not only preferences, but increasingly expectations. There's going to be big challenges for companies like McDonald's. After this call, we've figured it out. I'm going to basically go and put on a short position in my 40X mutual fund on McDonald's Corporation at 1%. Why? There's a new CEO. They're talking a lot about trying to extract value through various financial engineering ideas, whether it's share buyback. They had a big buyback in Q2. They're talking about separating the real estate from the operations. Never once has the new CEO, Steve Easterbrook, or I should say very little, has he talked about food, menu, health, wellness. And this is a mega trend that I believe is going to pressure their business, especially with the minimum wage increase that they had to put in this year in the U.S. restaurants. McDonald's is a company like Procter & Gamble. McDonald's has not grown earnings in the last 2 years, yet their multiple has gone from 16 times to 20 times. People are looking for 10% earnings growth next year, and in my mind, I question whether it's going to happen. So if you look at a company like McDonald's, let me first give you an example of Procter & Gamble. You're probably aware this stock has gone from 95 to about 70, so a 27% cut year to date. And it's because in 2011, Procter earned $387, was given a 16 multiple in June 2011. In June 2012, they earned $386. The stock stayed flat, multiples at 17. And then it started 2013, 2014. Here's this multiple appreciation phenomenon, which is probably led by quantitative easing, where Procter basically went from $65 at the end of 2012, June 2012, to $80 at 2013, to $95 at June 24. And basically their earnings the whole time was $387, $386, $403, $414. Why has the stock gotten crushed? 2016 outlook was cut from 5% earnings growth to minus 4% earnings growth from 414 to 386, and the multiple has coincidentally come in as well. If I look at the outlook for McDonald's, again, this is what is there not to like about the golden arches. But what I would say is the company did phenomenally well in their tenure of Jim Skinner going into the recession, and since then the company failed to capture the health and wellness trend, recognize it around them. And in 2011, the stock was at $100, 19 times 527. 2012, 16 times 537. 2013, 17 times 555. And now all of a sudden we have a cut of earnings to 468 $1.68 this year. The stock is hanging in there, and my prediction is we're going to end up with about a minus 10, minus 15% earnings. Multiples come from 20 to 16. I think this stock has 30% downside risk in it. I'm going to try to express that in my portfolio, in part because I believe this is an opportunity to create alpha by taking very active view within large S&P 100 components and trying to call winners and losers.
Hey, Min.
As far as
Man, don't want to cut you off. In fact, we'll probably keep this going as well. But we're at the 10 o'clock mark, and I just want to make sure. So I had a faux pas, and I apologize. I called your firm Meridian, and it's AeroPoint. I just want to make sure we have that clear, so we give you guys the right clarity there. But also, I want to open this up for question and answers. See if anybody's got any Q&A for you. And then if not, I think Jeff and I actually have one or two questions. So for people that need to drop off at 10, that's great. I don't know when you need to leave, Min, but we could certainly go on 5 or 10 minutes more. That's not a problem if it's okay with you.
I'm open on my end.
Okay, good. Well, let's see if we got any questions then. And Jeff's got that portion in front of him, so he can actually read any questions that may come in. So if you guys can use the chat feature, that would be great.
Okay, Min, one question is, what kind of sectors do you see outperforming in Q4? We covered a lot of the sector performance in Q3 from Tom, but what's a forward view that you may have?
Yeah, so I'm happy to talk sectors. It's hard to talk sectors and timing. That's guaranteed to be wrong on one. We talked a little bit about healthcare at the beginning, and basically, to your point on Hillary going out and talking about drug pricing, a lot of this has really been kind of lightning in a bottle. I'm not sure if you saw, but a lot of this hit the news when Turing Pharmaceuticals, a guy by the name of Martin Shkreli, like a 30-year-old ex-hedge fund guy, who bought this startup pharma company and took this pill called Daraprim from $13.50 to $750. That's the biggest risk will be pricing in biotech, but essentially I still see enormous innovation coming out of that industry. And the reason being is that next generation genetic sequencing tools have allowed companies to have much more targeted approaches to drug discovery. But think about the oil and gas industry and how they found oil and gas before the advent of 2D seismic and 3D. And companies like Illumina, Pacific Biosciences, they're essentially providing the tools for drug discovery to happen. I would envision biotech and probably large cap pharma to a certain degree, that biotech to be a very interesting area. A lot of risks right now near term, but we're looking through that. And then I also have to believe that there's an opportunity in energy, and active managers, I believe, have a responsibility to take a stand on this one. We are heavily overweight energy in Q1. That provided a lot of the outperformance for the year. We lost some performance. We didn't scale that position down, so probably lost half of our output from energy in Q2. But again, as I do the Saudi Arabia math, and I can literally put a timer, I can count the days to their FX reserves go to 0 at 50. I'm looking for the best ways to get the risk exposure I'd like to have in energy.
Okay.
Hey, man, I have a question for you that's kind of been burning. I wanted to ask you earlier anyways. One of the things that we've been focusing on is dividend payers, like the champions, right, that are, have had steady dividend growth. Do you, at this time, think that they're overvalued? And do you think that if we have Fed rate increases, that'll impact the dividend payers as well?
I think in the near term, whenever the Fed moves, basically that's an action that may trigger someone to think differently about their position. So, Jeff mentioned, Fed, does it matter or not? For the real economy, no, it doesn't matter. Does it matter to the point that you don't know how other books are positioned, how risk is set, and how they may cause something bad? That is an issue. To your point on the dividend payers, I am taking a very hard look at companies that are innovating and the ability to grow their dividend, as opposed to companies that are trying to do tricks to maintain their dividend, and really have to do with where is that company 5 to 10 years from now. So if anything, I would still look for dividend growers as opposed to just dividends at this point.